A buyer walks into an open house outside Dallas and does the math on their phone twice, because the first number feels like a prank. The detached home has the yard, the driveway, the privacy, then the monthly payment lands like a punch. 2 hours later, they're touring a townhouse 5 miles away, similar square footage, newer finishes, a smaller price tag, and a quiet line item that can explode later. HOA dues. This isn't a lifestyle debate, it's a capital test. Right now, that decision is urgent. Over the last 5 years, Americans have watched the gap between I can buy and I am locked out widen fast, then harden. According to Redfin's national median sale price data, single-family homes rose roughly 28% from late 2020 to late 2025, while townhouses climbed about 26%, close enough that one local swing can flip the winner in your metro and your portfolio. And here's the uncomfortable part. The next 12 months may punish anyone who treats those categories as interchangeable. Builders are leaning into more attached product as affordability breaks, and buyers are getting payment sensitive in a hurry. If you're buying, selling, lending, or investing, you need to know which product actually held value and which one can trap you when inventory shifts and fees spike. 5 years is not a long time in housing until you look at what happened between 2020 and 2025. Remote work rearranged demand, construction lagged, and then the rate shock hit like a door slamming. Price charts stopped describing wealth and started deciding who gets to move and who gets stuck. That SY single family versus townhouse stopped being a taste question and became a risk question. In many suburbs, the detached home is the default, the thing agents point to when they say safe. Townhouses get pitched as the compromise. Close the payment gap. Avoid the condo label. Yet the last 5 years didn't reward slogans. They rewarded micromarkets, supply constraints, and the buyer who shows up with the right product at the right payment. According to Redfin's national median sale price data, single-family homes rose roughly 28% from late 2020 to late 2025, while townhouses climbed about 26%. That's a tight spread until you remember what drives outcomes: monthly payment, neighborhood scarcity, and who your next buyer will be when the market gets choppy. In some metros, townhouses outran detached homes. In others, they trailed, and that difference matters if you're pricing a listing, advising a borrower, or underwriting an investment. The next leg isn't about aesthetics. It's about liquidity when inventory loosens and fees reset. Housing has done this before. After 2008, affordability and credit standards reshuffled demand, and neighborhoods were repriced based on what buyers could actually close. The trap entering 2026, people anchor on old comps while the buyer pool resizes in real time. If this kind of data-first breakdown helps you make smarter moves, hit like and subscribe. It's how we keep producing videos that treat housing like the financial instrument it really is. All the data sources mentioned in this video are listed in the description, so you can verify every number and dig into your own market. The national numbers are useful, but they can also lull you into a bad decision, because nobody buys the United States. You buy Phoenix or Philly, you buy a school district, a commute, a block with a certain kind of inventory. That's where the single-family versus townhouse fight gets real, and where the last 5 years can teach you something uncomfortable. The winner wasn't a property type. It was the product that matched the buyer's pain point in that specific metro. According to Redfin's housing market data and metro-level reporting tools, there are places where townhouses ran ahead of detached homes over the last 5 years, often in markets where the entry price for a detached home jumped so fast that the next buyer simply couldn't follow. In those metros, the townhouse became the release valve. It wasn't glamorous. It was functional. It offered a way to stay near job centers or good suburbs without swallowing the full detached home payment. When rates moved up, that gap got louder. Buyers didn't just ask, "What's the price?" They asked, "What's the payment?" And they started choosing whatever kept them inside a monthly number. Now look at what that implies for operators. If you're relisting a townhouse in a market where it functions as the main on-ramp for first-time buyers, you're not competing with detached homes the way you think you are. You're competing with the buyer's rent, with their student loan payment, with their car note, with the idea that they can wait. The townhouse wins when waiting feels worse than paying HOA dues. It loses when buyers get leverage and start demanding concessions. That leverage has been creeping back in, and you can see it in the temperature of the deal. According to Redfin's recent reporting on December 2025, activity buyers gained negotiating power in many markets, with a typical home selling for less than the final list price and a smaller share of homes selling above list than in the hotter years. That matters for this debate because townhouses, in a lot of metros, sit right on the most payment-sensitive shelf of the market. When buyers get picky, they don't just negotiate the price, they start interrogating the product. What are the dues? What do they cover? When was the roof last replaced? Are there special assessments? In a softer moment, those questions slow deals down. Detached homes have their own story. In some metros, the detached product still held the edge because of scarcity and because the buyer who can afford it tends to have more financial slack. The same rate shock that squeezed the middle also created a split. Market cash-heavy and high-income buyers kept shopping while everyone else recalculated. According to Redfin's National Market Overview for late 2025, Prices were still up year over year, even with rates elevated, and transactions stayed relatively low. Low volume is not a calm market. Low volume is a market where a small shift in listings or demand can whip prices around fast. That's where a lot of people misread the last 5 years. They see townhouses almost kept up nationally and assume stability. The truth is messier. In metros where new construction delivered a wave of attached product, a townhouse can become less rare than people expect, and rarity is what protects pricing when the mood turns. In metros where townhouses are a small slice of inventory and sit in premium locations, they can trade like a constrained asset. Same label, totally different behavior. Here's the warning for consumers. If you're rebuying a townhouse because it feels like the safer payment, you still need to stress test the full carrying cost. Rates can fall and make payments feel better. Dues can rise and erase that relief. Here's the warning for operators. If you're re-underwriting appreciation based on a national average, you're taking market risk blindfolded. The last 5 years weren't a straight line. They were a series of jolts: pandemic demand, then inflation, then the rate snap, and each jolt rewarded a different buyer profile. If you don't map the buyer profile to the product in your metro, you're guessing with 6 figures on the table. The next question is not which appreciated more, it's which is about to get stress tested. Townhouses have been gaining relevance because the market is quietly admitting something. A huge slice of buyers can't clear the detached home payment anymore. According to the National Association of Home Builders, the share of newly built townhouses has climbed to record territory around the high teens as a share of single-family starts on a moving average basis. The strongest in a data series going back decades. That's not a trivia stat. That's supply responding to a broken affordability equation. If you're an operator, that shift is both opportunity and warning. Opportunity, because attached product is getting institutional support. Builders, lenders, and local governments can all stomach density that still feels like a house. Warning, because when more of the pipeline looks the same rows of similar townhomes, similar finishes, similar HOA structures, the asset behaves less like a scarce suburban trophy and more like a payment-driven commodity. Commodities reprice quickly when demand flinches. Demand has been flinching. According to Redfin's January 15, 2026 reporting, pending home sales fell sharply in December, with the typical home that did sell taking longer than usual for that time of year, a sign that buyers are hesitating under high costs and uncertainty. Hesitation doesn't hit every product equally. It hits the product that's sold primarily by monthly payment math. That's townhouses in a lot of metros. And the townhouse payment is not just mortgage principal and interest. The townhouse pitch, it's cheaper than a detached home, often ignores the second meter running in the background: HOA dues and shared maintenance obligations. Those obligations can be benign in year 1 and brutal in year 5, right when you're trying to refinance, sell, or stabilize a rental. According to the Wall Street Journal, rising costs for insurance, repair, and maintenance have been pushing HOA dues higher, sometimes faster than overall inflation. That is a valuation issue. A buyer who can tolerate a purchase price may still walk away from a monthly obligation they can control. Then there's the darker version of that story: special assessments. People hear special assessment and think condo tower, not townhouse community, but the mechanism is the same. Deferred maintenance meets higher labor and materials costs, then shows up as a lump sum bill. According to the Wall Street Journal's reporting on special assessments, those unexpected expenses can run into the thousands and sometimes far beyond, and they often arrive when owners are least prepared. Even when the assessment isn't catastrophic, the perception can be. A buyer sees headlines, asks their agent one more question, and suddenly the townhouse that looked like an easy resale has a friction premium. This is where recent history matters. After the 2008 crash, the market relearned a hard rule: when credit tightens or payments spike, buyers stop paying for ideals and start paying for survivability. In that kind of environment, attached product can outperform because it's the only bridge into ownership. The same environment can also punish attached product because buyers become allergic to unpredictable ongoing costs. Both can be true, and the swing factor is local governance and the quality of the HOA's balance sheets, something most buyers never read until it's too late. You can already see the market rewarding caution. According to the National Association of Realtors' latest existing home sales reporting for December 2025, prices are still edging higher year over year, but activity remains constrained, and the market is sensitive to financing conditions. Low transaction volume creates fragile price discovery. A few motivated sellers, a few cautious buyers, and the comps you rely on can go stale fast. In a townhouse-heavy submarket, that can translate into sudden air pockets, where sellers have to chase the market down, especially if multiple similar units hit at once. So the second chapter isn't a victory lap for either product type, it's a warning label. Townhouses are becoming more central to the American housing machine because they solve for affordability on day 1. The risk is what happens on day 900. Dues rising, insurance shocks, reserves that don't cover aging infrastructure, buyers who learn to fear the fine print, Detached homes carry their own risks, bigger ticket. Bigger exposure if your job or rates turn, but the ownership structure is simpler, and simplicity sells in anxious markets. If you're buying or underwriting in 2026, the edge is not picking townhouse or single family. The edge is knowing which side of your metro is about to be flooded with similar attached inventory, and which side has attached product that is truly scarce, and knowing exactly what the HOA can demand from an owner when the bill comes due. What the last 5 years really proved is that appreciation is not a personality trait of a property type. It's a function of who can still buy, what they can still finance, and how much ugly detail sits behind the monthly number. According to Redfin's national median sale price data, detached single-family homes did edge out townhouses from late 2020 to late 2025, but the spread was narrow enough that a single metro can reverse the story completely. That's why the safest move in 2026 is not picking a label, it's underwriting the next buyer. If you're a consumer, treat the decision like a stress test, not a tour. For a detached home, run the downside on rates and job risk. Make sure the payment survives a bad year, not just a good one. For a townhouse, do the same. Then add the HOA reality, read the budget, look at reserves. Ask about insurance, pending litigation, and whether special assessments have happened before. According to the Wall Street Journal's reporting on HOA and assessment pressures, fees and surprise costs can change the math fast, and owners don't always see it coming until it's too late. If you're an operator, agent, investor, lender, stop relying on national averages as comfort. Track your submarket's pipeline. If new attached inventory is stacking up, price like a merchant, not like it's 2021. If attached inventory is scarce and the HOA is healthy, that product can be a defensive play when detached payments keep buyers frozen. If you're holding rentals, model dues rising, and insurance repricing, build a buffer you don't want to need. One more thing, liquidity is the hidden risk people forget. In a tightening market, you don't lose money only by being wrong on appreciation. You lose money by being wrong on exit timing. The best asset is the one you can sell without begging the market. So here's the question I want you to answer in the comments. If mortgage rates drift down but HOA and insurance costs keep rising, which one becomes the better deal in your city, detached homes or townhomes? Hit like and subscribe if you want more breakdowns built on real market data. And remember, all the sources cited in this video are listed in the description.